Cathie. We appreciate a lot your time for this interview with Infomoney.
My pleasure, Mariana and Paul. Very, very happy to be here.
Great. So let's Cathie, there is still a lot of doubt about when interest rates in the United States will start coming down. And this is, of course, an issue for tech stocks, which are ARK's core business. What is your outlook for this segment in 2024?
Well, we think we've paid our dues when it comes to interest rates. In 2021, as investors began to worry about interest rates going up, and then even more so when they actually went up in 2022, our funds were hurt very badly, as all long duration assets were. Even the bond market had its worst performance since the 1700s in the United States. So there was no way we could have escaped it. But we believe that we have paid our dues, as I said, that interest rates have peaked here in the United States, and we would submit elsewhere in the world on balance, and that interest rates will come down this year for a few reasons. One, we believe that investors will conclude that inflation was transitory. It was much more because of a supply side shock, supply chain bottlenecks, than it was about monetary policy. In fact, the money growth has been negative on a year over year basis for the past year. And the yield curve has been inverted for a year and a half. Those are harbingers of recession. And we believe we've been through rolling recessions. In the United States, some measures of housing are down by 40%. If you look at the sum total of new and existing home sales, they're back down where they were in 2008 during that crash. And so housing's been in a recession. Auto sales are, I would say, they are not in expansion territory. They're very weak by historical standards. Commercial real estate, especially with offices, is unwinding. We expect to see a lot of defaults. And now that companies have lost pricing power, many did use COVID as an excuse to raise prices, and the consumer said, no mas, no more. And of course, they are now cutting prices. So we think the big surprise in 2024 is that broad-based inflation goes negative, that we see deflation. And I think the Fed will ease aggressively as that happens. We're seeing even food companies like Conagra are saying, you know what? The consumer is not coming back. And, the consumer has to eat. What they're doing is they're trading down and are not willing to pay higher prices for, higher end goods. So it's very interesting to see even the staples companies saying, oh my gosh, our units are down. That rarely happens.
Hmm. But do you think that the Fed is making a mistake by keeping interest rates at the current level for so long?
Well, we think they made a mistake in raising interest rates 24-fold. So not 24%, but 24-fold over little more than a year's time. And we're going to see a lot of fallout from that, we think, in the next year. We saw the first fallout, which was the regional bank crisis this past March in the US. And so we're still seeing outflows from regional banks. So their problems have not gone away. These high interest rates in money market funds are a tremendous amount of competition for the banking system. So deposit outflows are continuing. And that's why money growth, M2, is down on a year over year basis.
Hmm. Hmm. And what's your outlook for rates and economic growth this year in the United States? Do you have a number, a magical number that you pursue?
Well, I'll start with interest rates. As I said, I think the big surprise is going to be deflation. Certainly to the Fed, they don't think it will. They think they're going to have trouble getting inflation to 2%. We think it's going to go to 2% and continue down. Of if you look at the metals price index, so broad-based metals divided by the gold price index, you will see that that correlates very well with long-term interest rates, especially since 08, 09. It's really remarkable. Until last year, the metals to gold ratio went to its lows, the lows since 08, and the long-term treasury yield went out to 5%. If this correlation were to have continued, and we think it will, um, interest rates should be at 2%, not 5%. So we don't know if long rates will get to 2% this next year, but we think they're going to go down a lot more than most forecasters believe. One of the reasons, as I mentioned, is deflation. The other reason is if we're right and companies have lost pricing power, they're going to have to cut their prices. That's how we get deflation. Uh, and they're probably going to lay people off because their margins are going to come under extreme pressure. And so the unemployment rate will go up, and that means consumption is the next shoe to drop in this rolling recession. Now, because the recession has been rolling, we would say for 2 years, it's not going to be a severe recession like 08, 09. This is just the last, this is the tail of it. But it is an election year here in the United States. We think the government is going to be under all kinds of pressure to stimulate. And on the fiscal policy side, we know that gridlocking Congress is going to prevent much from happening at all. Nothing. We would be surprised to see much happen. And so the policy that will need to address this situation is monetary policy.
Mhm, mhm. Okay, great. Kathy, last year we saw an artificial intelligence fever
Yes.
within the markets. Do you foresee this trend continuing into this year, or are there other areas that present more promising opportunities in your view?
Well, the breakthroughs in AI have been astonishing and remain astonishing. We chart these models, the large language models, and how much their performance is improving. And one after another, they're improving dramatically. Artificial intelligence training costs are dropping 70% per year. And when the cost of something drops that much and it is so useful, anyone who's used ChatGPT correctly will know that it can save us a lot of time writing, especially almost anything. And so, this utility, we think we're going to find more and more use cases. Now, what happened last year was enterprises woke up thanks to ChatGPT to this innovation. Finally, it's been great for innovation based strategies. And they woke up and they said, oh my goodness, we got to figure this out. And so they started throwing all kinds of money at it last year. And what we think will happen this year, and what always happens with innovation when there's a rush in, is the CEOs, CTOs, CFOs, all the C suite will say, wait a minute, all of these divisions are doing something different. We have to think strategically here. So you could get a little bit of a pause, a reset. And I'll bet people will talk. Let's just say NVIDIA gets hit hard based on this. I bet a lot of people will talk about, that was just a fad. It is not a fad. It has just begun. And we think the ramifications for productivity are going to be profound. We think that the productivity of knowledge workers is going to increase fourfold in the next 6 to 7 years. And that's that. that when productivity increases, then usually there is a lot of wealth creation along the way. And so it's going to be very important to become a part of this movement, get on the right side of change. Now, what we also think is that artificial intelligence is and will remain the biggest catalyst to other kinds of innovation because of the convergences we're seeing between and among technologies. So, to give you an example of that, um, we're known for our investing in Tesla. Tesla is the biggest AI project in the world today. And what I mean by that, autonomous taxi platforms are the biggest opportunity out there in terms of billions of dollars of revenue. In fact, the entire ecosystem around autonomous taxi platforms, we think globally, will deliver $8 to $10 trillion in revenue from nothing today. uh, $8 to $10 trillion in revenue over the next 5 to 10 years. With artificial intelligence, there is a winner take most phenomenon. So, in the case of autonomous taxi platforms or robo taxis, the company that gets people from point A to point B as quickly and safely as possible is probably going to get the lion's share of the market. We think that company in the US is Tesla. So it's an enormous opportunity. So AI, in this case, is working with robotics. Autonomous vehicles are robots, and energy storage. They will be electric. Total cost of ownership of electric vehicles is much lower than the total cost of ownership of gas powered vehicles now. And so you've got robotics, energy storage, and artificial intelligence converging into autonomous taxi platforms and creating a completely new business model. Oh, and the other thing that'll happen out of it, which is very important for humanity, is 80 to 85% of all accidents, auto accidents, and deaths in auto accidents are caused by human error. This is taking human error out of the equation. And so in the United States, the number of lives lost in auto accidents per year is 45,000. So it will save 35 to 40,000 lives per year. Globally, that number is 1.25 million people. So it's really important. Innovation solves problems, and this is a very good use case of innovation.
Great. You mentioned NVIDIA, and ARK made the decision to divest most of its stake in NVIDIA before the stock rocketed. Could you explain the reasoning behind this?
Sure. Well, uh, our we initiated our position in 2014 when we were starting the study of autonomous and artificial intelligence and learned that NVIDIA, which at the time people thought was nothing more than a PC gaming chip company, NVIDIA was $5. I know recently it peaked at $500. We enjoyed most of that ride. Uh, and, uh, and we believe that for every dollar in hardware spending associated with artificial intelligence, there will be $10 to $20 of software spending. And the software companies in our portfolio were valued nothing like NVIDIA. And software companies should be valued more highly than hardware companies, right? Now, NVIDIA is starting to get into software, but it's not in its DNA per se. So companies like UiPath and Twilio, we were buying when they were while Nvidia was 20 times sales, they were 3 to 6 times sales, and they're software companies. So they were completely destroyed by the increase in interest rates. Nvidia led the pack out. We're just going to the next set of winners. And I'll also say If you listen to any of my interviews, our interviews in 2014 to 2019, you would have heard us pounding the table on NVIDIA, saying people don't understand how important this company is going to be. They still think of it as a PC gaming chips company. When the market understands more about a company in terms of innovation, we're usually going to take profits, because what happens is the momentum moves that quantitative strategies encourage take many of these stocks way above the valuations uh, they should be, where they should be. Now, NVIDIA, we don't think is going to be a bad stock. We think it's going to be a good stock. It's just we think our stocks are going to be better. The valuations are much lower. They are AI plays. Um, Tesla, I think at the time we were selling NVIDIA, we were buying Tesla and Coinbase. Those also have had magnificent moves since their lows. So in portfolio management, you can look at a sale, but you have to look on the other side of that sale. What is the buy? Tesla, Coinbase, Twilio, UiPath, and all of them are starting to work. And in fact, Coinbase last year was up, I believe, more than Nvidia.
Hmm. And are those four stocks your great um, choices for this year? And
Well,
so on, not only this year.
yes, yes. Well, we publish our holdings at the end of every day. Our top holding is Coinbase, followed by Tesla, and then Roku. Actually, I can get that. I can pull them up right here. Coinbase, Tesla, Roku, UiPath, Zoom, Block, and CRISPR Therapeutics are the top 7 stocks in the portfolio. We're very excited about those, as the other 3 in the top 10: Roblox, Twilio, and Unity Software. So we do think that all of these stocks were punished during the interest rate increase and ended up way below where they should have been, and they're very long-term growth stories, and maybe super growth stories during the next 5 to 10 years.
Well, Kathy, Coinbase, which is your first top pick, is a Bitcoin play, right? You're a strong supporter of Bitcoin. Kathy, do you maintain our previous prediction of one BTC reaching value of over $1 million? Could you elaborate on why you consider it a sound investment?
Yes. Well, we believe that each one of the words I'm going to say is important here. So we believe that Bitcoin is the first global, digital, private, decentralized, rules based monetary system in history. That is a very big idea. And in fact, when we gained our first exposure to Bitcoin in 2015 through GBTC, when Bitcoin was $250. And we had just written our first white paper in collaboration with Art Laffer, who is known for his supply side economics, Laffer curve, and so forth. And when he read our paper first and then gave us input, he said, "This is what I've been waiting for since we closed the gold window in 1971." And I said, "Wow, Art, this is a big idea." And I said, "How big is it?" Now, at that time, Bitcoin was $250, which put it at roughly a $6 billion market cap or network value. And he said, "Well, how big is the US monetary base?" And at that time, it was $4.5 trillion. And so from that moment on, I knew this was a very big idea. And yes, how do we get to a million plus? Well, the first is digital. Bitcoin is the equivalent of digital gold. Gold is a $12 trillion asset out there. And we do believe that Bitcoin will get a nice slug of that. We also do believe that in emerging markets where monetary and fiscal policies can go wild and actually ruin purchasing power, wealth, we believe that most emerging markets are going to use something like Bitcoin as an insurance policy against confiscation of wealth. And inflation is confiscation of wealth. And outright confiscation, of course, is confiscation of wealth, capital controls, and all of that. But then the third, that's another big push, that we expect in demand. Then the third is institutional, and a spot Bitcoin ETF, we do believe is close to approval here in the United States. We hope to be one of the spot ETFs approved, and institutions know that if there is a new asset class, and we believe that digital assets are a new asset class, that that the correlation of returns with other asset classes is going to be low. And what that typically means is the return per unit of risk when you incorporate Bitcoin into your portfolios, your return per unit of risk will go up. And institutional investors know they cannot miss those sorts of opportunities. We think that's going to be the biggest push into Bitcoin. Now, today, there are 19.5 million Bitcoin outstanding in the world. Some of them have been lost, but they're outstanding and maybe lost, but they're out there. The number of Bitcoin that we believe will ever be outstanding is 21 million Bitcoin. So the scarcity value as institutions push in is going to increase the price, we think, fairly dramatically. So right now we're in the $42,000-$43,000 range. It won't take much. Institutions may be putting 2 to 5% of it in their asset allocation. Will get it there easily.
Cathie, are the institutional investors the only ones who will be drawn to a Bitcoin ETF, or do you think it'll be what kinds of investors could be drawn to it?
Yes, well, we know that the early adopters have already gone through a lot of friction and have set up wallets and so forth. So they're set, and those are probably not the target market. Unless they want to buy a Bitcoin ETF, which, unlike Bitcoin itself, uh, banks will consider ETFs collateral for loans. So that might be a reason someone who already owns a lot of Bitcoin might want to diversify a portion of his or her holdings into an ETF. So that's possible. The next the target market, or the market we are targeting at the early stages of the launch, will be those individuals who've been reading our research for the last 8 years and they're curious about Bitcoin, but they've never done anything about it. And the tagline I think that we're going to use in advertising is going to be something like, "Aren't you a little bit curious?" So I kind of like that, and because there are a lot of people who, they've been thinking about it, they've been trying to understand it, and we've been trying to help them along the way. We put out Bitcoin monthly. We've been doing that for the last year using where it's based on chain analytics, and really gives investors a sense of the health of the network and how stretched the valuations are or are not. And then we also do a Bitcoin brainstorm every month. We've done 6 of those. And what we're trying to do there is introduce investors to the Bitcoin community, the people who are really making this happen, the developers and the wallet providers, other, those who have started their own funds. We just want to introduce them to everyone. And we've even done one with Art Laffer, where Art is there, poking holes, trying to poke holes, as any normal individual would. We want to help them do that. So we'll have someone like Art Laffer try to poke holes into the ecosystem. So just trying to educate, as we've always done with all kinds of disruptive innovation.
Kathy, is ARC's ETF ready to start as soon as SEC gives it approval, or if it gives this approval?
Yes, we are.
But Kathy, the previous year was marked by significant events in the crypto space, right? Not only price-wise, but we had things like Sam Bankman-Fried getting arrested, CZ departing from Binance. How do you perceive the current state of confidence in the crypto
Yes.
market, particularly among new individual investors? Do these incidents affect the trust in the industry?
Um, uh, they actually proved the concept. Why did FTX go bankrupt? Um, well, it was a completely closed system, so opaque. We couldn't see inside that institution. It was centralized and it was fraudulent. What is Bitcoin? Bitcoin is completely transparent. You can see every wallet address and transaction on the platform. That's what on chain analytics are all about. So, completely transparent and completely decentralized. And so it's a giant neighborhood watch. I don't know if you have neighborhood watch in Brazil, but in neighborhoods, the neighbors look out for each other in something called neighborhood watch. So, all of these developers that are living off the Bitcoin ecosystem, they want to protect it. And so the more decentralized, the more secure it is. And so I think that FTX going down, Sam Bankman Fried going to jail, um, uh, CZ stepping down, the SEC, which has been fighting Bitcoin and fighting a Bitcoin ETF for a long time, it has been doing so for those reasons. They wanted to prove their point, and the point they proved is uh, centralized, opaque institutions are not as healthy in terms of an infrastructure as these decentralized, transparent networks are.
Okay, great. But talking about the characteristics of Bitcoin, the future of Bitcoin can be solely dependent on an ETF approval, right? So imagine we don't get an approval, or maybe it doesn't come the way we think. Uh, what what more Bitcoin can rely on to keep growing?
Yes, I think that in addition to playing a role like gold, except digital gold, a lot more transportable, um, and institutions. If there's no Bitcoin ETF, we're already seeing institutions move in, and using their own wallets and own custody and so forth, or working through Coinbase to do that. So institutions are already moving in. So we still think that's a large market. A Bitcoin ETF will make it larger, make it easier, and therefore larger. We think the emerging market use case is still there. In fact, a number of the Bitcoin brainstorms we've done have featured individuals working on the Bitcoin ecosystem in Africa. So alive and well there. And then we also think that high net worth individuals uh, will will buy into Bitcoin as insurance policies for the same reason as emerging markets will, confiscation of wealth, except it's a little different. Sure, they can be in inflationary areas, but wouldn't the crown prince's cousins in Saudi Arabia have been happier if they had invested in a little bit of Bitcoin and kept the private key in their heads or some other location. Uh, MBS came in and just took their wealth as he locked them up in the Ritz Hotel in Riyadh, right? Well, if that's because they could see the wealth. Uh, Bitcoin again is pseudonymous, and so outright confiscation of wealth is a reason high net worth individuals will also continue to buy into Bitcoin, we believe.
So, talking about emerging markets, you mentioned Africa, but recently we saw a regulatory pushback in the US, right? So many companies, including Coinbase, which is your topic, shifted a little bit their focus from US to emerging markets, including Brazil. They mentioned
Mhm.
a lot. How do you anticipate the evolution of this market into emerging markets? What are the benefits from this shift? And of course, does ARC have any plans to expand into markets like Brazil?
Sure. Well, we do own some South American stocks right now. Mercado Libre is an amazing company, probably the best. I think it might be one of the best managed companies in the world. So, and they're getting more aggressive with Pago, and they're experimenting with crypto digital assets as well. Um, so the 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 answer to your question is we've learned from Block, so Square, which renamed itself Block, that it has been almost impossible for a company like Block to work through regulatory infrastructure and ecosystems in other countries. And so, what Block is doing is using Bitcoin to get into other countries. One of the use cases I didn't mention is remittances. And with the Lightning Network now, we're going to see more and more in the way of remittances. That is a $700 billion market today, even though Western Union and other companies charge anywhere from 8 to 25% to send, $100 back, which is terrible. Bitcoin, it costs hardly anything. So we do think that that's another source of the movement into the rest of the world, remittances, very low cost remittances. And yes, we want to follow and watch the companies that are embracing this new technology and are going to are going to use it to enhance their own products and services. So, yes, we're watching very carefully how it travels out there and who's doing what. In our venture fund, we do have a company called Chipper Cash, which is African. We do not have yet a South American company. We do have Nubank in our fintech portfolio, um, and yes, so again, we're looking at. We know that if we're right, and there's kind of the last vestige of recession that we need to be careful, but we'll use any downdrafts to leg into positions of companies that we think are doing the right thing in terms of embracing these new technologies.
Great. Kathy, coming back to the other ARCs funds, you had a very successful year in 2023, but the other ETFs have yet to fully recover from losses of 2022. So,
Mhm.
what should investors anticipate for this year?
Well, one of the things that has interested us in terms of a dichotomy is that the NASDAQ, S&P, Dow, MSCI World are all close to their old highs. And our funds, depending on the fund, are still down 60% or more. Um, and one of the reasons is because of where interest rates are and fears that they will stay higher for longer. If we're right and interest rates continue to move down here, Long rates are leading short rates. The yield curve is inverted. If we're right that they're going to move down closer to that 2 to 3% range for the long, um, that should bode very well for our portfolios. Um, in 21, as the NASDAQ was hitting a new high, we were down more than 20%. Why? Because algorithms looked at our portfolio, which doesn't look anything like the big benchmarks by design. um, they looked at ours and say, oh, okay, this is the best bet, the way to bet against a group of stocks that higher interest rates will hit. And so 25% or more of ARKK, our flagship strategy, was short. And it's still that way. There's still a huge short position. If interest rates come down, then that short position will diminish. They'll have to cover by buying our ETF. So that's a lot of latent buying power, we think, that has yet to be dislodged. And we think convincing evidence that the Fed is going to cut, and we think that convincing evidence will start this quarter, will help our strategy.
Great. Cathie, Infomoney caters a broad spectrum of investors here in Brazil. Would you like to provide some investment advice for them for this year?
I have to be very careful. My compliance department would caution me here. I can only tell you what we believe is going to happen. Um, we believe there will be a recession, but we've been through a rolling recession. This will be the end of it. We believe the unemployment rate will go up. That will encourage the Fed to drop interest rates. So any asset that benefits from lower interest rates, and most assets do, by the way, is probably going to do well. Commodities, if we are in a recession, probably will not be a standout performer. I mean, the lower interest rates will help, but we think the demand environment is going to be pretty tough. One of the most interesting charts I've seen recently is inventory levels. And they companies couldn't keep inventory on the shelf during COVID, and so they ordered and then double ordered and then triple ordered and quadruple ordered, and they still haven't brought their inventories down. They have not started to fall. They ordered way too much. So that is one of the big shoes to drop here, and that will be one of the last. The market is a discounting mechanism. So the stock market is already looking, as you could tell from our performance last year, at lower interest rates. Now we just need confirmation to keep our kind of strategy moving forward. And of course, if interest rates are going to come down, then bonds should do well. Corporate bonds probably won't do as well as treasury bonds because of the recession risk. But they had such a horrible couple of years as interest rates went up that we think they'll also benefit now from interest rates coming down.
Great. Cathie, I would like to thank you so much for this conversation and hope that we have the opportunity to repeat it sometime in the future.
Oh, thank you so much, Mariana and Paul. I enjoyed this immensely.